To fulfill the targets of the Paris Agreement, the world economy must reach climate neutrality by 2050. There is now a wide consensus on the fact that this pathway is likely to rely on 5 complementary pillars. First, the accelerated development of low-carbon electricity sources, renewable and nuclear, this to decarbonize the existing system as well as to accompany new uses in industry and mobility. Second, development of low-carbon gases such as hydrogen and biomethane, this to tackle the technical limitations from the electricity-based decarbonization solutions arising in industry and mobility. Third, vast energy efficiency improvements, particularly in the building sector. Fourth, large-scale deployment of carbon capture, utilization and storage processes in industrial activities relying on fossil fuels and or facing the most pressing challenges to decarbonize. And fifth, development of negative emissions generating processes such as BECCS and DAC, bioenergy with carbon capture and storage, and direct air capture.
To reach net zero emissions by 2050, we're going to need considerable amounts of investments in infrastructure. We're talking about potentially tripling the current rate of investments, so that by 2030, we're at around $4 to $4.5 trillion worth of investments in renewable and clean energies. There are 2 main bottlenecks that will be facing the metals and mining industry over the next decade. The first bottleneck relates to underinvestment, because over the past few years, metals and mining industries have been underinvesting in future output. In fact, CapEx has only been half as much as it used to be over the period between 2011 and 2012. This is problematic because of the long lag time that the metals and mining industry needs from the time they invest to the time that output comes to the market. On average, a copper mine, it will take around 17 years from start to completion. As such, we're now expecting a decline in metals output and minerals over the next decade. The second bottleneck relates to China's quasi-monopoly on some very important metals and the potential for weaponization of these metals, as we've recently seen an example of gallium and germanium.
Trillions of capital will have to be channeled to low-carbon technologies and assets in the next decades to decarbonize the world economy. The financial sector has a major role to play, this through 2 complementary ways. First, by taking appropriate risk when and where needed to support low-carbon technologies at the various stages of their readiness level. And second, by developing new financing solutions to support the decarbonization of hard-to-abate sectors. In this respect, the current emergence of regulatory as well as voluntary carbon markets offers promising prospects. By putting a price tag on the value of carbon either emitted or saved, these markets could channel quasi-equity funding to low-carbon investments. Commercial banks can actively support the development of these markets by devising carbon financing solutions. In a sense, these solutions leverage the carbon value of climate-friendly technologies and projects.